Welcome to our presentation, A Beginner's Guide to Investing and Retirement. In this presentation, we will go over some of the basics to help you start your retirement and investment journey. So let's go ahead and get started. So here's our agenda for today, where we will begin by reviewing the 5 who, what, when, where, and why questions on investing. We will go over inflation. We'll talk about identifying your goals and risk tolerance in regards to investing. We'll cover some different types of investment vehicles as well as different types of retirement accounts. We'll also go over some strategies on investing and how to get started. And we'll end with some additional resources. So we will now cover the 5 who, what, when, where, and why questions regarding investing. So we can kind of ease into our discussion about investing, since oftentimes it can be a very heavy topic and it could be a lot of information to digest. So who can invest? You can invest so long as you have an SSN or an ITIN number. So this practically means that anyone can invest with the right information and resources. So what is investing? So investing is how you make your money grow for long-term financial goals. So you can start at any time. The earlier you start, the more you will reap your benefits. And where you decide to invest depends on personal factors. So this may include your age, your level of risk aversion, and many others. And why should you invest overall? So investing is an effective way to put your money to work and potentially build wealth and accomplish those long-term financial goals. So now that we've kind of covered what investing is in a nutshell, we'll kind of go over some particulars and some details on investing. So inflation is known as the silent killer because inflation is the rate at which the value of currency is falling, and consequently the general level of prices for goods and services is rising. As of right now, inflation is currently sitting at 3.3%. In this graph, we can observe that inflation started decreasing over the past year compared to the previous years, and as shown on the graph, it has remained relatively steady from May 2022 up until 2024. However, it's important to note that inflation can decrease and increase depending on the state of the economy, as we can see from this graph. Considering the impact of inflation, the value of your money today may decrease over time, making investing essential to grow your wealth and maintain your purchasing power. So as we can see on this picture on the left, this kind of covers that topic in a gist. So in 1913, for 9 cents, you were only able to purchase a quart of milk. And fast forward to 1963, instead of that quart of milk, with 9 cents, you can only get up to a small glass. And in 2017, that amount has decreased even more, with being 6 tablespoons for 9 cents. And if we were to kind of continue to do that up until 2024, that amount of milk would be way less than those 6 tablespoons. So this kind of covers how it's important to invest if you want to kind of maintain your purchasing power and build wealth over time. So now that we've discussed what investing is and inflation, it's important to understand the nature of your investments and your financial goals. So it is essential to define the purpose behind your investment. To do this, you want to ask yourself a couple questions. So first being, what is it that you are investing for? How much time do you have available for investing? And what level of risk are you comfortable with? So some individuals may want to invest for retirement, to buy a house, or perhaps both. It's important to remember that each goal has a different time frame. So what this means is that, for example, you might want to retire at 60, while you might want to buy a house before you're 35. So you might have a little bit more room to work with for retirement, but not as much with buying a house. So that just kind of will help determine the level of aggressiveness or conservatism that you're willing to adopt in regards to how you invest. And in the following section, we'll kind of delve into what risk tolerance is so that you can kind of define this concept with this context and be able to kind of map out your different financial goals. So, having discussed what your motivations may be, it is essential to assess what your risk tolerance is before you begin your investment journey. So, however, before we do this, I'll briefly go over what risk tolerance is. So, risk tolerance is the level of risk an investor is willing to take. So, for example, here's a scale of risk tolerance, and it starts from low risk and it goes all the way to high risk. And there's about five in between stages between the low and the high side of the scale. So being conservative on this scale means that your primary goal is to preserve capital, even if it means missing out on potential returns. Being moderately conservative on this scale means that your primary goal is to preserve principal, but you're willing to accept a small degree of risk for gains. And then being moderately aggressive or being moderate on this, like it's almost right in between. So being moderate on this scale means that your primary goal is to reduce risk and enhance returns equally. And then being moderately aggressive on this graph means that your primary goal is long-term returns and that you're willing to accept significant risk. And then being aggressive means that your primary goal is maximizing returns, which may endure extensive volatility and significant losses. So that's kind of the scale in a nutshell, so that it can help guide you kind of map out your financial goals in regards to investing. So another way to kind of think about risk tolerance is to see it as a correlation between risk and return. So this graph is from Investopedia, and it shows that the lower your risk is, the lower the amount of the return, and the higher your risk is, the higher the amount of your potential return. So that's kind of another way to kind of think about it. So now that we've kind of discussed the importance of investing and refining your goals and risk tolerance, now we'll kind of go over the different types of investment vehicles so that you can begin investing. In this presentation, we will go over the following investment vehicles: so bonds, stocks, mutual funds, index funds, and exchange traded funds. So we will begin with bonds. So for the first type of investment vehicle, bonds are IOUs or loans that you can make to the government, a corporation, or an organization to raise money. In return, you will receive earnings based on the interest payments they promised you for the money you loan them over a specified term. However, there are some important terms that you need to know when discussing bonds. So, face value refers to the purchase price of the bond. Maturity refers to the length of the time it will take to repay. And then lastly, the coupon rate refers to the interest that is paid to the bondholder. And there are also different types of bonds listed here from least to most risky. So starting with the least risky, which is federal government bonds, then there's those two in between on that scale, which is municipal bonds and corporate bonds. And the most risky on this scale is high yield bonds, which are also known as junk bonds. Okay, so just like everything, there's pros and cons. So here are some pros and cons to bonds. So first, some pros. The prices tend to fluctuate less compared to stocks, so there's a little bit less risk to it. And because there's less risk to the prices fluctuating, this can provide a level of steady income. However, there are some disadvantages, which is that they kind of have lower long-term returns, so you can't really expect it to be more long-term. And then companies can often default on your bonds. So now we will move over to discuss stocks, which is another investment vehicle. And they're oftentimes referred to as equity. Investing in stocks provides you with ownership or equity stake in a company. And as a shareholder, you are entitled to a percentage of the company's assets and annual profits. And those annual profits are known as dividends, as well as ownership rights. And shares can be sold for a gain or a loss and are typically traded for a stock exchange. Now, here are some pros and cons for using stocks as an investment vehicle. Some pros of buying stocks are that they have a potential for higher returns than bonds do, and some stocks pay dividends. However, a disadvantage of stocks is that the stock prices can fall and rise dramatically, and there is no guarantee on return. So there's this level of uncertainty almost. While stocks can be beneficial, they also pose some risk. So let's go over some ways in which we can reduce the number of risks. So for example, you may wish to opt for a long-term horizon, so 10 years plus, to reduce risk, and you might want to diversify your portfolio. However, now the question stands on how you would diversify your stocks. And to do so, you may want to consider other investment vehicles like mutual funds, index funds, ETFs, etc. Which will bring us to discuss mutual funds, which is another investment vehicle where a group of investors professionally manage a portfolio that may consist of stocks, bonds, or other investments. The whole purpose of this is to outperform the market, and they are bought and sold once per day. So now that we've kind of discussed mutual funds as an investment vehicle, let's consider some of the pros and cons like we've been doing for the other investment vehicles. So some advantages include that mutual funds diversify your portfolio. They provide convenience and ease of management. However, there are some disadvantages, which include the presence of fees. So index funds is another type of investment vehicle that we will cover. And this is a form, this is the key difference that index funds are passively managed compared to mutual funds. And they aim to track the performance of a specific group of assets or a basket of securities, such as the S&P 500, which tracks the performance of the top 500 companies in the US. Unlike actively managed funds, index funds typically have lower fees and are well diversified. They can be purchased in dollar amounts and traded once per day, and this makes them a great option for new and inexperienced investors. And some examples of index funds are like the Schwab S&P 500 Index Fund. So this is a great choice for someone who's just starting out. So similarly to index funds, exchange-traded funds are another investment vehicle that contain various types of investments such as stocks, bonds, and commodities. The key difference between index funds and ETFs is in the way that they are bought and sold, and ETFs are traded throughout the day like stocks, and you can buy them in whole shares, and they offer lower expense ratios, although transaction fees can vary. So here's like the comparison between the index fund and the ETF. So as we can see, here's a breakdown of an index fund and an ETF, which both track the total US stock market index. So they vary in type, they're different in types. So the VTSAX is an index fund, while the VTI is an ETF. They are both in the same in how much they cover in stocks. So they both have 3,493 stocks. The fees do differ by percentage. So the index fund is 0.04%, while the ETF is 0.03%. And then they also vary in how you can trade them. So for example, you can trade an index fund once per day, and an ETF, you can trade it in real time. They also differ in how you can buy them. So the index fund you can buy in dollar amounts, and ETFs you can buy in shares. And they also vary in how you can kind of the minimum investments that you have. So for example, the index fund requires a much larger amount, which is $3,000, while the ETF requires a much lower amount, which is one share, which roughly is around $154. So those are just kind of like the differences between the index fund and the ETFs. So they both contain the same stocks and perform this kind of in a similar way. The only difference is how you buy and sell them. So now that we've covered the investment vehicles, we can now discuss where you can put them. And this presentation will focus on retirement accounts, but please note that other types of investment accounts are available to you and that share other investment goals. There are two types of of retirement accounts. And the first retirement account is an employee-sponsored retirement account, while the other one is an individual retirement account, which is also known as an IRA or an IRA. There are two types of employer-sponsored retirement plans. And the first type is the 401k, which is a retirement account available to employees who work for private for-profit companies. In 2024, the contribution limits for this type of account were $23,000 for individuals under the age of 50 and $30,500 for those over 50. Another type of employer-sponsored retirement account is the 403b, which is offered to employees who work for nonprofit organizations or government entities, and the same limits apply for 2024 from the 401k. There's also, it is important to note that anyone with earned income can open a retirement account. Students can have an IRA and an employer-sponsored account. Now that we've kind of discussed employer-sponsored retirement accounts, we can kind of delve into IRAs or individual retirement accounts. And there are two main types, similarly to the employer-sponsored one. So there's a Roth IRA and a traditional IRA. So the Roth IRA allows you to make after-tax contributions, and this means that your money grows tax-free. However, there are income eligibility requirements if you are a single tax filer, and you must earn less than $139,000, and if you are married and filing jointly, you must earn less than $206,000 to have this type of account. And then the contribution limits are for both of them are the same, which is if you're under 50, you should be contributing up to $7,000, and if you're over 50, you can contribute up to $8,000 per year. And then the traditional IRA, with this type, you can make pre-tax contributions and you will pay taxes when you withdraw funds, and there is no income eligibility for this type of account, and anyone with any form of income can contribute. And the contributions are the same for the Roth IRA and the traditional IRA. So now that we have gone over investing and retirement accounts, it is now time to decide what kind of broker you may choose to go with. A broker is a person or an entity that arranges transactions between the buyer and the seller. And there are two different types of brokers, which are a DIY portfolio and robo-advisors. So in this slide, we will be discussing the DIY portfolio. This form of a broker saves fees by managing a simple 3-fund portfolio through a self-directed brokerage account. So some examples include Charles Schwab and Fidelity. The second kind of broker we will be considering is robo-advisors, which are digital platforms that provide automated algorithm-driven investment services with little to no human supervision, balancing across accounts for more tax efficiency. This provides simplicity and diversification. So some examples of this include Betterment, Wealthfront, etc. We will now discuss general strategies to guide you in your investment journey. Okay, so the first general strategy for retirement funds is known to be the easiest, which are target date retirement funds that are named after a target retirement year. And they are index funds, which means that you are not paying a fund manager, which means that it does have lower fees. And each single fund holds several index funds and they reallocate over time. So for example, a 2770 DTF is for investors who plan to retire around 2070. TDFs are often a popular choice for retirement savers because they help investors choose a fund that matches their retirement timeline, and the fund's mix of investments will automatically change over time to become more conservative as the target date for retirement approaches. So for example, a fund might start with a mix of a higher risk, higher reward assets like stocks, but shift to a mix weighted more towards bonds as the target date gets closer. So that's kind of what a target date retirement fund strategy would look like. And another strategy that we have for you in this presentation is a portfolio that contains 3 asset types and use low-cost index funds or ETFs. So for example, if you were to open an account with Vanguard, if you were to follow this strategy, your portfolio will look like buying US stocks, international stocks, and bonds. The same principle applies if you were to open an account with Fidelity or Charles Schwab as seen on previous slides. Having digested all this information, you may wonder, how can I start? First, you want to figure out your why, so why you're investing, kind of assess your risk tolerance, and then open a brokerage account, fund that account, and use your funds to buy investments. This way you have a more of an organized approach to investing, which can help you in the long run to achieve those long-term financial goals. Here we have provided some additional resources to help guide you through your research and in your investment journey. So NerdWallet is a great resource to kind of look over some articles or podcasts about investing. Investopedia has a lot of information that we've shared about inflation, about the different types of limits that there are, and then we also have some different articles and websites that you can visit to kind of do your own research about investing, which we have listed here below. That is all that we have for you today. Thank you for watching this presentation, and I wish you the best of luck in your future endeavors. Thank you.